Didn't this bill get passed on the 4th of July?
Yes.
It was signed into law on the 4th of July.
Mm-hmm.
I remember when it came out because we, with the newborn, we're not going out and seeing fireworks. I remember when it came out, it was like breaking news. And I looked over on the couch and I was like, what are you doing? You're like, I am trying to digest this 890-page bill that was just passed. And that's how I knew you were different.
Welcome to Money Dates, the podcast that makes money conversations with your partner feel a little less taboo. I'm Natalie Slagle, a certified financial planner, and I'm joined by my husband and business partner, Dan Slagle, also a certified financial planner. Say hi, Dan.
Hello.
In each episode, we'll share honest stories and practical tips to help you and your partner feel more connected and confident on your financial journey. So grab your drink, get comfortable, and join us for our Money Dates. Welcome back, Dan.
I'm happy to be here, Natalie. Happy Thursday at the time of this recording. I just have to say, I really like your shirt, blouse. What's the proper term for it?
I love that you don't know, and I don't want you to know.
It's like a crop top. Maybe it's a crop top.
Not really. No, it's just like a tank shirt thing. I was thinking, okay. I'm like, is this plaid? Or I'm calling it picnic table.
Oh, yeah. When I look at that and you said, is it plaid? It's plaid. Then when you said picnic table, it's 100% picnic table.
Yes. Now, it also is very, I would say, I dressed up for the episode in the sense that I wanted my shirt to match the topic, which is Congress just passed this huge bill. And so I'm patriotic today.
You are. You're wearing red and white. And look at me. I'm wearing blue.
Oh my gosh.
We didn't even know it, but we are fully embracing. We're still in the month of July, right? Mm-hmm. So we're fully embracing the 4th of July. We didn't dress up on the 4th of July, so why not do it a few weeks later?
Our daughter did. I put her in a cute little. It was subtle, but it was dressing up. Okay, so today we're going to get a little bit more technical. And
boo.
I know. I was having kind of some thoughts about this, but we actually had a couple clients ask hey, are you going to have a podcast on this huge legislation that just got passed? And I was like, no, that's not what this podcast is about. And I'm like, okay, give the people what they want. And maybe by showing a little bit of our technical side, people who aren't our clients can get a glimpse of how we go about talking about these things. Because this bill, we've already sent a lot of communication to our clients and to our followers about kind of breaking down all the different things. Literally everyone in the US is impacted by this bill. Everyone. There's no escaping it. Well, I'm sure there's ways. There's always ways, but it's a big deal. So we're going to break it down. I'm not going to get too technical, right? Because this is a podcast. If you want to get very, very technical, that's when you set up meetings with us. But I think it's important for us to just kind of break down some of the big things. We can't break all almost 900 pages worth of everything, but we're going to break down the things that we think our audience would benefit from having a conversation about. So that's what we're talking about, Dan.
Let's do it. Let's dive in. Going back to the 4th of July, didn't this bill get passed on the 4th of July?
Yes.
It was signed into law on the 4th of July. Mm-hmm. I remember when it came out because we, with the newborn, we're not going out and seeing fireworks. I remember when it came out, it was like breaking news. And I looked over on the couch and I was like, what are you doing? You're like, I am trying to digest this 890-page bill that was just passed. And that's how I knew you were different in a good way.
Yes. This was after the working hours. Our baby was in bed and I was like, I want to read this because everyone was trying to digest it. And I'm like, well, this site is saying one thing and this site is saying something different. And it's not. So I'm just going to go to congress.gov. I don't remember what the website. It's something like that.
And meanwhile, my mom and your mom and I were sitting on the couch, waiting to start Squid Game. And you were reading this bill and we were just like, It's the last season of Squid Game. Let's go.
Well, it's not. It's the latest. It's not the last season.
Well, I don't think it's been confirmed yet.
Oh, well, then what was the last? Well, okay, no spoilers. Anyways, okay, let's dive in. So to me, one thing that's not talked about a lot that I think warrants a conversation, even though it will feel like, and this is what I try to explain to clients, like nothing really is changing from what's happening, but marginal tax rates. So we have 7 different brackets. I don't have them all in front of me, but we have 7 different ones. The brackets that we're in today, and then so there's like the 10%, the 12%, blah, 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 blah. The brackets that we're in today, they're staying the same. And that is a huge impact. That actually has a lot of impact too on the revenue that the US federal government collects because they were set to expire. The tax rates were set to expire, which means we were going to have higher tax brackets and the bands, so income from 100 to 200,000. Again, I'm making that number up, but the bands were going to be less favorable from a how much tax am I paying perspective. So because of the Tax Cut and Jobs Act that Trump put into place during his first term, all of these tax rates and brackets were set to expire. So that was a plan. And Dan, you and I, for our clients, like we have been planning on that expiring. Therefore, starting in 2026, everyone was going to have to fork over more money. And that impacted our clients' retirement projections, right? And so now we know. Now we know that it is not expiring. People are not paying more in taxes, at least from this specific thing. And so tax rates are going to stay the same. So I think people aren't talking about it because it's like, well, what's there to talk about? It's like, it's just like staying the same, relatively speaking. But to me, I'm like, well, if you're a planner, like you were not expecting it to stay the same. And therefore, like that has an impact.
Yeah, absolutely. I think the technical term that we've seen, especially leading up to 2025, 2026, is the Tax Cut and Jobs Act sunsetting. Like,
yes.
Wasn't that, and you're using expired. Like, why can't we just say end? Why does it have to sunset?
Because that's not fun, Dan. Our world isn't the most exciting, so we have to use fun things like sunsets. But this bill is not called the sunrise of the continued. So I don't know.
Sunset is like very American. Like I picture like the Marlboro. I have trouble saying that. Marlboro man, like riding his horse off into the sunset, and you just get this beautiful picture of what's going on. Sorry. Anyways, go back to the bill.
Of like tax brackets and tax rates. So to me, this, like a lot of people are saying like, oh, there's this new bill is adding $5 trillion to the US debt situation, which this podcast is not going to dive into US debt because I know a lot of people have questions and talks about. Dan, you're like, no, we're not talking about that today. But this is a big reason why. This is a big reason why that debt is getting added to. It's because the revenue that was before the new bill that we were going to get if they did let the Tax Cut and Jobs Act expire, we were expecting to get, we as in the US government, they were expecting to get more revenue through ordinary income, through taxes this way. And now that it's been set to what it hasn't been reset to higher tax brackets, higher tax rates. That's a loss in revenue for the US government. So that is a huge reason why the $5 trillion added to the US debt is in place, is because these tax rates and brackets are going to continue at, I would say, historically lower rates. To me, this is kind of a wake-up call of, wow, we were this close. A different administration could have let that expire or sunset or whatever we want to use. And so, the hard thing with financial planning is we can't predict the future, but I'm starting to lean a little bit more towards Roth contributions, Roth conversions, because the tax rates we're in today are still historically low. At some point, my guess is that that's going to change. And so obviously, when you listen to this podcast, we are not giving any specific recommendations to anyone. We're just having conversation about it. But like, I'm looking at Roth contributions now, and I'm looking at people, that 24% tax bracket. And I'm like, maybe we should be a little bit more favorable towards Roth contributions, conversions, or whatever it may be. Those are my thoughts. Anything to add, Dan?
No, I think you hit everything squarely. I mean, if we can get more money in to Roths now, most of our listeners are in their 30s and 40s. Like it's way more advantageous going forward, wouldn't you say?
Right. And I mean, depending on the tax bracket that you're in today versus the tax bracket that you're in the future. And so it is likely people in their 30s and 40s, it is maybe more likely than not, by the time you take the money out, you're going to be in a higher tax bracket. And that's just from like a specific household. You'll probably be making more, right? Or your balances will be more. But then also now we can look at it through the lens of, well, what is Congress deciding today? What will they decide in the future? And to me, just looking at it from a congressional perspective, I think at some point, again, I don't have a crystal ball, but I think at some point, like taxes are going to need to be raised or spending is going to be cut. It's no different than what we do with our clients. Like we got to balance the budget here, folks. The US government has got to balance the budget. We either got to make more money through taxes or we got to spend less on all the expenditures.
I was just going to say the same thing. I think we should move on from marginal tax rates and we should talk about some deductions now.
Yes. So I'm going to hit on this real quick and I'm going to throw your dad under the bus, Dan. Okay. You ready for this?
Okay. I think he listens. I don't think he listens, actually. Go ahead.
Well, this will be a test. So Dan's dad, if you're listening, you have to tell us you heard this because I'm throwing you under the bus right now. When this bill came out, we had a bunch of family in town. We already know my mom was in town. Your dad was in town. And your dad said to me, they're not going to tax Social Security anymore. And I was like, oh, really? I haven't come across that yet. And your dad was wrong. This is me throwing him under the bus. You were wrong. But he was wrong in the sense that he was misguided. It was not his fault. So there was this big post from Social Security, and the verbiage of it was extremely misleading, in which people thought that they were interpreting it as, oh, there's not going to be taxes on Social Security. That's not what's happening. The deductions for seniors have gone up. There's a difference here. So there's a lot of deductions now for seniors. Man, people 65 plus, as long as your income is within thresholds, you can get a married couple can get up to $46,700 in deductions. That's a lot.
Wow. And I thought like the senior citizen discount at McDonald's or like your dad getting the national park pass was a deal. That sounds amazing. Dive in up to 46,000.
Yes. So this for a married couple filing jointly. So you have the deduction that you and I would qualify for, just the standard deduction of $31,500. Then for anyone 65 plus, blind or disabled, you get an additional $1,600 per person, right? So times that by 2. And then the new and temporary deduction is $6,000 per person. So that's an extra $12,000. So altogether that adds up to $46,700. Now, because that's such a big deduction, and a lot of people, a lot of seniors who are taking Social Security, their total income on their tax return could be less than the $46,700 total in Social Security payments. If that's their only income, maybe it's $35,000. So because of the deductions, all of your income, which could only be Social Security, isn't taxable. But it's not that Social Security isn't taxable. It's just the deductions are higher. So that's the confusion. Talk to us if you want to learn more about it. But I think we have clients who this applies to, our clients' parents this applies to. So I just wanted to clear the air on that. And thank you to your dad.
I think you make a good point as well. It's just like sometimes the things we hear from our parents or the advice that we get or the guidance, like we do need to do a little digging into it, right? Sometimes we need to take it with a grain of salt. Sometimes it can be correct. Other times it may be misleading. And I think we've all experienced that.
Yes, absolutely. Like my mom was telling me about this article her friend read, and it also had to do with Social Security, but it was so wrong. And I was like, oh man, our like the boomer generation and up I just feel for them because there's a lot of misguidance out there. Okay. That's just kind of the standard deduction. And then that's the deductions for seniors. A big change in deductions happening is the increase in the state and local tax deduction, or otherwise known as the SALT deduction. My sister always used to say, I say SALT funny. Do I say SALT funny?
Say it again one more time.
SALT?
Salt? No,
SALT.
I don't think so.
She used to say it like I would say SALT. She kept like making fun of me. I remember this conversation to my sister. If you remember this, she's going to be like, yep, you used to say it funny. Maybe I don't say it funny anymore. Okay, anyways. So the state and local tax deduction, this is huge. I got to do this because Trump signed this bill, right? I got to make a Trump reference. So this is increasing from $10,000 to $40,000. This is really huge for those folks living in high income state tax. What am I trying to say, Dan? The states with high income taxes.
Yes.
Yes, that's what I'm trying to say.
Yes, that's what you're trying to say.
Let's list those. Minnesota, Oregon, New York, California, Massachusetts, New Jersey. I think there's a few others, but those are kind of like the top states that tend to have higher state income taxes. So if you live in one of those states, this change specifically could take you from taking the standard deduction to itemizing deductions. And that's important to realize because now you have to start paying attention to those itemized deductions again, right? And so...
Which a lot of people don't, right? Like just to call that out, especially like our generation, it hasn't really been a thing.
Mm-hmm.
And like, I think you should go through some of those deductions. Like maybe people should start keeping track of in case they do, it's more advantageous to itemize their deductions.
Exactly. And so you're going to have to start paying attention. I mean, a lot of these things will come on forms, but your property taxes, your W-2 will show your state and local income taxes, your charitable deductions. This is the big one because so many of our clients, they'll just like a friend is raising money for some sort of organization. Great. I'll send you $100 to support that. Those like one-off contributions, you should start paying attention to that because it's likely the demographic that we're talking to here, you're going to switch to itemizing deductions and charitable deductions is going to be a part of this. Now there's change to the charitable deduction. We'll talk about that in a second. But the other change that is happening is the private mortgage insurance. So PMI, private mortgage insurance, you pay that if your loan to value ratio is above 80% on your home. So let's say you bought your home and you only put 10% down. The bank is going to charge you an extra premium because you don't have 80% down, right? That premium is now deductible on your itemized deductions. So that's what PMI is. The other thing that kind of has to do with this, that this is just kind of a comment, is we have kept the ability to deduct the first $750,000 of mortgage. They say indebtedness, but it's really just in normal terms, like the first $750,000 of mortgage, of your loan value, you can deduct that interest. Okay. So the reason why I want to flag this is this was put into place like kind of during COVID times, this number. And what's happened since then is interest rates have skyrocketed. We've seen prices of homes increase. And so this is kind of one of those things where we miss the opportunity to kind of elevate this, to kind of match it to the environment we're in today, because like a lot of our clients are buying homes that are worth $800,000 or more, having significant interest payments. And that now isn't really matching with the environment that we're in today. So that was kind of like, oh, I wish they would have taken a second to increase that, but maybe the next revamp. Okay, so we kind of went through the kind of housing, state and local income taxes. Any questions or thoughts, Dan, that you want to add?
Well, we talked a lot about SALT and other deduction. Do I say SALT funny?
No, I don't think so.
Okay. All right. Just checking. But there's been changes like in the amounts for itemized deductions and standard deductions as well. Is that correct?
Yes, exactly. So that has gone up, and for a married couple filing jointly, that is up to $31,500. And I believe, I don't have this in my notes in front of me, I believe that is indexed for inflation, which is nice because some of these things like the child tax credit, that has also increased this year. And that's going to be indexed for inflation. It used to not be. It's been like $2,000 for a really long time. And so some of these things, it's like it wasn't indexed for inflation. Now it is. That's really great. And so having, whatever we can to have it indexed for inflation, like, yes, the answer is always yes to that.
Yeah.
Okay, a couple other call outs just with the itemized deductions. I brought this up for a split second, but there's a floor now on your charitable contribution. So again, the reason why we need to capture every single dollar or have kind of proof and deduct every single charitable contribution is there's now a floor. So 0.5%, so 0.5% floor. It's 0.5% of your AGI. So to give an example, your AGI is $350,000. Your floor, 0.5% of that would be $1,750. If you make a cash donation of $2,000, you can now only deduct the difference. So you did a total of $2,000, but there's this floor of $1,750. So now you can only deduct $250 of that. So there's some planning opportunities here on like how to take advantage of this. This does not take effect until 2026. So if you've been kind of feeling like I want to give a lot of money away, 2025 could be the year to do it because there's no floor. So you'll be able to deduct if you're able to itemize. So that there's kind of some planning opportunities there. The last thing on the itemized deductions, and then I need to take a breather because wow, it takes a lot to get through this.
It's a lot to get through. Yeah.
It's a lot. Is there's now a limit. So itemized deductions are reduced by 2/37, which I'll explain that in a second, but that's just how the rule is for taxpayers in the 37% tax bracket. So if you're married and you make essentially over $751,000, your itemized deductions now have a reduction and a limit. There was no limit previously, so that this one's kind of a bummer, but that's how that is. Okay. What about if you're not itemizing? What happens then? Ready, Dan?
Tell us. Yeah, seriously, you are just spitting fire right now. Just keep going.
Okay, so if you're not itemizing, here are some things to be deductions that will be applicable to your situation. So charitable deductions, when you are not itemizing, you could actually still take a deduction for. So let's say, Dan, you and I it is not advantageous for us to take the itemized deduction. Well, if we still donate to charity, we can deduct up to $2,000 for a married couple, $1,000 for single. That's pretty cool. To me, this is a huge win for charities because I think people are more incentivized if you can truly say, hey, you're going to get a deduction for this. Yeah. So this is not subject to any floor. So if you're itemizing your deductions, you're subject to that 0.5% floor. If you're not itemizing deductions, there's no floor. It's just like, oh, I took the standard and I can do this. So again, planning opportunities here, because maybe some years it makes sense to take the standard, do more of your charitable deductions. That I don't know, my brain, I'm just like all these cool things. And there's also a lot of different rules around what kind of charities you donate for, what kind of assets you're donating. Is it cash? Is it stock? Is it property? Things like that. Not going to get into it, but like a really cool, to me, this is a huge win for the nonprofits out there, for the charities, that more people are going to legitimately be able to deduct their contribution. So I'm a huge fan of that.
That's amazing. Yeah, very cool. I honestly, I feel like I'm back in my tax class that I took in college right now. I feel like we should talk about some other things that are maybe a little more exciting than deductions. What do you think about that?
Sure.
Actually, hold on. I take that back. There's a new opportunity for deductions for new car loan interest, which I think could apply to a lot of listeners. So I believe the rule now is up to $10,000 of interest can be deducted on new cars that are assembled in the United States, right?
Yes. Yep.
So
makes and models assembled in the US.
Okay. And we'll link to a blog that we wrote. And we should have said this earlier on. We'll link to a blog that we wrote, that Natalie wrote. I shouldn't take credit for that you wrote on our website most recently about all of these changes. So we'll link to that. Within that blog, we have a list of different makes and models assembled in the US. So the deduction applies to interest on new loans taken after December 31st of 2024.
Yes.
And I do believe there are certain phase outs of the deduction based on your modified adjusted gross income. We don't have to get into the details, but I think that's something that people should be aware of, especially if they're thinking about purchasing a new vehicle going forward.
Mm-hmm. And what's fun, I think my definition of fun is different for others. I get that. But if you have an existing loan, so Dan, I was looking into this for us because we have a loan on our car. And if you have an existing loan and it's refinanced in 2025 or later, the interest on the refinance loan will qualify as long as you're not increasing the balance of the loan. So that's awesome. I'm like, oh my goodness, we could benefit from this. But of course, you need to check if your vehicle qualifies. Now, I remember when we purchased a Toyota RAV4, they were talking about how it just got off the boat from Japan. So I'm like, oh, I'm still going to look into this. If it just got off the boat from Japan, I don't know. So in our blog, and we can link to this in the show notes too, you can check if your VIN qualifies. And did you know this, Dan, that the first letter or the first number of your VIN can tell you where it was assembled?
I didn't know that. That's kind of like the dollar bill, right? Like, isn't that a thing? Like it like the numbers on it actually match up to the Federal Reserve that printed the money.
I did not know that. That is a fun fact.
Might be making that up, but I feel like I saw that on like a show back in the day, like Mythbusters. I don't know what myth they would be busting, but something like that.
So Dan, what letter do you think our VIN starts with? Pop quiz. Well, it's not a quiz because you never looked at
I don't want to give our VIN away to everyone because I feel like I'm just going to rattle off letters that I feel like I remember. I'm going to guess V.
No, it is
whoa. Okay. T.
No. Okay, think about this. Let me give you stop guessing.
J.
J. J for what's J stand for? Where's our car from?
Japan.
Yes.
Oh,
so Toyotas.
Okay. I thought you were like trying to link J to our daughter, who's also named J. I thought that's what was going on. I missed the point where you had said like the first letter might indicate where it's actually from. Or
yes. Maybe. So if you have a Toyota, it is very likely that your VIN starts with a J if it was assembled in Japan. So ours was assembled in Japan.
I want to check everyone's VIN out now. Like that's very interesting to me.
Yeah. No, go to the website. It's cool. It like tells you all these things about like the first letter or number will tell you where these things are.
Wow.
Anyways.
Very cool.
Okay. So there's the qualified tips deduction, the overtime pay deduction. The overtime pay is important for the medical community because those are the people in our world, our client base that does tend to have overtime or people who work in the medical profession. So pay attention to that. There's a phase out for it for $300,000 for married filing jointly. So some of our clients, like they do have overtime, but because of their income, they'll be above the threshold. So there's that.
Oh, cool. Very cool. We were done with deductions, but I mean, these are really important. I wanted to be done with deductions like 5 minutes ago. Let's talk about some tax credits. Like those are more exciting, aren't they?
Let's do it. Do you want me to go or do you want to start?
I'll just go. I think the most notable change to a tax credit that applies to us and our listeners is the increase to the child tax credit. Would you agree?
Heck yes.
Yeah. So we go from a whopping, we go from $2,000 to a whopping $2,200. But like you said, adjusted for inflation.
And if you don't know, I'm sure a lot of people, because they're not in this world, they might not fully embrace the difference between a deduction and a credit. And a credit is so much more advantageous because it literally like dollar for dollar makes your situation better. A deduction just deducts your taxable income. And so a $200 credit is so much better than a $200 deduction. So even though it's only up $200, it is on the credit side. That is really nice. So yay.
Yay.
increase in the child tax credit.
Other news for credits, unfortunately, things like, or I should be unbiased when I say this, the EV tax credit is set to expire, not sunset, expire after September 30th of this year. And then the residential clean energy credit will also expire with respect to no expenses or expenditures made after the end of this year. So I think those are the big credits that we hit on, correct? Am I missing anything?
Yes.
There's a lot.
Well, this is really important for those who are in the private marketplace for health insurance. Premium tax credits for health insurance under the ACA, Affordable Care Act, were not extended past December 31st, 2025. Therefore, without further action from Congress, if you're getting some sort of credit for your health insurance premium, that is set to go away. And that is going to have a significant impact on our self-employed folks. So continue to pay attention to that.
Okay. Yeah. Let's get into the last two topics that we have. And I think this podcast might run a little longer than normal just because there was 890 some pages of this bill that we have to consolidate into one episode. The last two things, accounts for children, new changes to the 529 plan. Do you want to talk about those?
Yes. So they've kind of expanded the definition on what you can use a 529 plan for. Like the big thing is cost for tutoring outside of the home. And it's funny because they specifically say it can't be a family member. And I'm like, but what happens if your family member is a professional tutor or just very smart? My tutor that I had, I'm married to. So you know what? I didn't. You were my tutor. Yeah, you were my tutor for the Series 7 exam.
I was. That's right. Woohoo.
So I could not have, if that was happening today, I could not pay you from my pretend 529 plan.
That's okay.
And then the other thing is educational therapy costs for students with disabilities, including occupational, behavioral, physical, and speech language therapies. That is an approved 529 plan distribution, a qualifying expense. So that's exciting.
I think the other really exciting change, I believe, is like the new category of qualified expenses for like more post-secondary, like credentials.
Mm-hmm.
So like fees for continuing education necessary to maintain a credential, exam costs for a credential. So like Natalie and I are certified financial planners, CFPs. Like we have to do continuing education, pay costs. There are fees associated with it. If we had 529s, we could technically use those dollars for things like what I just explained. Is that correct?
Yes. Well, I saw something that there's still some clarification with it, but I think that's going to end up being the case, which then it's like, well, are all these employers going to like be opening 529s for their employees? I don't know. I don't know what it means. Like, I don't know what that means, but it just feels like the 529 plan is trying to encompass all things that have to do with increasing your education or your ongoing education, things like that. The other big call out here, which this impacts quite a few of our clients, is that the K through 12 expenses, because some of our clients, they're not only saving for college, but they're saving for K through 12. If they want to send their kid to a private school, something like that. It used to be you could only take out $10,000 per year. That has not inflated. I do not understand why, but they just doubled it. So now, the beginning of 2026, you can take out $20,000 per year for K through 12 expenses. So this is really, really impactful for those who have super funded their 529 plans and are sending their kids to private college. So that's pretty neat.
Interesting. Very cool. Very cool. Well, lastly, let's round out and talk about the infamous Trump account and the impact that has on families.
Yes. So the Trump account is interesting. I have many, many thoughts on this. It's a little bit more complex than I can probably even get into in this podcast. But essentially, there's different rules with the Trump account depending on if your child is in the year before they turn 18 or they're in the year in which they turn 18. Where do I even start with this account?
Let's talk about like I'll try to hit on the basics, and then you can just like hit the buzzer if I'm just like saying things wrong. Or, you give me the
It's like Taboo, where I'm like behind your ear with a little like zzz, zzz. I love that game.
So much pressure. So much pressure right now. Okay, so the Trump account, from my understanding, is going to be an account that you can open up for U.S. citizen born in, I believe, 2025. So this year, 2026 or 2027 as of right now.
Mm-hmm. Yes.
It's essentially an account that the U.S. government will credit $1,000 into, right, on behalf of that child or that citizen that was born.
Yep. Okay. In those 3 years, 2025, 6 or 7.
Okay. In those 3 years. So we missed the cutoff personally by like 6 months. It sounds like. Dang. Okay. Well, you can. So with the account, and again, just because this bill was just passed at the beginning of this month, there's a lot more things that need to be worked out that we're trying to stay on top of. But essentially, my understanding is up to $5,000 in contributions would be allowed, but those contributions are non-deductible.
Exactly, which is similar to a 529 plan. You put money into a 529 plan and you don't get any deduction for it. So it's the same with this account.
Okay, got it. Okay. So we'll hit on distributions in the future, because knowing that the contributions are non-deductible, we need to understand what's the taxation potentially at the end, right? When you withdraw money.
Exactly. Yep.
Okay, so we'll table that for right now. There can be additional contributions from other entities like governments, charities, employers that is excluded from income.
Yes.
I say it as a question, but like I'm quite like, you're the expert in the podcast room right now, and I'm explaining what I know, what I think I know.
Yes. So let's say you and I open a Trump account for our child. We can put in $5,000. I'm a little like, I haven't seen any specifics if it's like, if you're a single parent versus married filing joint, but let's just say the total amount is $5,000. I think that's what it is. So $5,000. Okay. So in addition, you could have your employer contribute to the account as well. And I don't have in my notes how much they can contribute as well.
Got it. Very cool. And then the money that goes into the account can be invested. The investments, I believe there are some parameters in place where you have to invest in like a U.S. equity fund. The fund itself has to be low cost. I believe last thing I read has to be around like 0.1% from a cost standpoint, which is effectively pretty low. So the money in the account, you can invest it and it can grow. Prior to 18, I don't believe distributions are allowed.
Correct. No distributions allowed.
Okay, got it. Let's talk about rules after the beneficiary turns 18. Do you want to hit on those?
Yes. So once the beneficiary turns 18, distributions are allowed, but they're subject to early withdrawal penalties before 59 and a half. So essentially, when the child turns 18, it kind of starts to act like an IRA.
Yeah.
And so what's interesting about this, and it's the same with like our IRAs, is that you are subject to early withdrawal penalties if you take a distribution before 59 and a half, but there are exceptions, right? So education, first-time home purchase. So all of a sudden, this account, it's kind of like a retirement account, but you can still use it for education expenses or for that first-time home purchase. And the withdrawal, so the direct contributions will be tax-free, right? Because we already paid taxes on our, $5,000 per year contribution. So we already paid taxes on it. So the direct contributions are tax-free. But growth, so, we put in $5,000, it turned into $7,000. If we took it all out, the $5,000 would be tax-free. The $2,000 would be taxable. And then that taxable would be where like the early withdrawal penalties apply and things like that. So like a big question mark that people have, are we going to be able to roll these into Roth IRAs? Like, could we roll the entire balance and pay taxes on the growth? And if the child's 18, maybe the child is paying taxes, because they'd be at such a low tax rate. This account was just created. So some of these rules actually haven't even been ironed out yet.
Yeah, like it from like the standpoint of like the earnings or growth being taxable. Like, I think there's still clarity that needs to happen with obviously they just started, right? So we're talking about potentially not until, if a kid's born in 2025, like 75 years from now. Well, that was easy math. In the year 3000, like they're right. No, 2100. Wow. Okay. That's embarrassing.
It's going to be the year 3000. I believed you when you said it. And I was like, I've never thought about the year 3000, but no, it will not be.
I haven't either. I was, the year 3000. I feel like I got that from like seeing A Hitchhiker's Guide to the Galaxy that was on my mantle the other day. Okay. Anyways, in the year 2100, to be clear, like as of right now, the required minimum distribution age is around 75. Like there are some rules in place where it could be, it ranges, but like 75 going forward. That could change, obviously, 75 years from now, whatever the rule may be, but you're going to be forced to take money out, right? In the form of a required minimum distribution, potentially. Yes. And if you were to pass away, the beneficiary of that money, like there's a 10-year rule in place where the account has to be depleted.
Right.
So I think like those items still need to be worked out on this Trump account. Obviously, the incentive is there to receive the $1,000 to make contributions into this type of account, but there's just so much gray area right now that we just don't know if this is ultimately a good avenue to potentially explore.
Right. And it's like, I did hear that most custodians, you're going to be able to open it. So we custody our clients' assets at Schwab. So we're going to be able to open these Trump accounts at Schwab. I think it'll be weird because usually it's like Natalie Slagle IRA, but it'll be Natalie Slagle Trump account. Like, oh, that's just weird.
Like forcing everyone's last name to become Trump.
Yeah, I know. I have a lot of feelings about that. But in general, like I cannot give advice. Remember, this is not advice to you listeners. This is just conversation. So I'm going to get like, if I gave advice to myself right now and I was like, okay, literally, I am giving advice to myself right now. So I want to save for our daughter's education. We are already doing that. We already have a 529 plan. We have a whole episode about saving for kids. You should listen to it if you haven't already. And with this Trump account, am I going to transition my savings efforts for my daughter's education to the Trump account? I will not be doing that because I can contribute more to the 529 plan. I get better tax incentive by doing to the 529 plan. And I can roll over unused balance up to $35,000 to a Roth IRA. So to me, for Dan and I, for the purposes of education savings, I really still believe that we should be doing the 529 plan. This is advice and this is guidance in my head to Natalie and Dan because I know our whole financial situation. This is not advice to you, listener. Unless you're our client, then you should just schedule a meeting with us and we'll talk about your thing. So we are disappointed in Congress that they made this new account with these funky rules when they could have made the accounts we already have better. So that's just my opinion on the matter. When I think about this whole bill in particular, it is very political. So a lot of these things have expirations on the last year that Trump is in office. So on his campaign trail, he made these promises like no tax on tips, no tax on overtime. Those things end when he's no longer in office. And I don't like things like that because to me, it's like I'm putting things in the tax plan that better my political career rather than what is best for Americans, just Americans in general, which I know it's really hard to do the best for everyone who has very different situations. But, you know, there's some things I like about this bill and some things that I think Congress could have done us all a lot better by. That's my opinion. If you were looking for it.
Your opinion matters, Natalie, for sure. Well, I think this is a lot to digest. I think there's a lot to still digest as more comes out, more news, more information comes out. So we'll do our best to keep you as listeners updated on the new bill. Again, be sure to check out our blog in the show notes that very nicely recaps everything we just talked about. So yes, if it was a lot for you to digest through listening or maybe watching, put some text behind it. Check out the show notes.
Awesome. All right. Thanks, Dan, for having this conversation with me.
Thanks. Bye.
Bye-bye.
Hey, if you've enjoyed this episode and are looking for personalized financial guidance, schedule a free complimentary consultation using the link in the description below. Natalie and Dan Slagle are the founding partners of Fuse Financial Planning, a registered investment advisor. The information provided in this podcast is for informational purposes only and should not be considered investment advice or a recommendation to buy or sell any securities. Investing involves risk, including the potential loss of principal. Advisory services are offered to clients or prospective clients where Fuse Financial Planning and its representatives are properly licensed or exempt from licensure. For more information, including our disclosures, please visit our website at www.fusefinancial.com.